Guys, welcome to the stream. Welcome to our show. It's another Dfi-nancial Friday show. Welcome. It's Alfred, as always, here from Diversified Capital. We got Raymond joining us. Raymond, what's going on?
Doing good. Looking forward to the 3-day weekend. I love these
3-day
New Year,
weekend.
winter break, how it used to be, and then having
Oh,
a holiday a couple weeks afterwards. So
what's going
seeing
on?
that now.
I'm still writing 2020 in my calendars. I don't know what you're
Are you?
talking about here, or at least in my spreadsheets. I got called out with a client earlier. It's like, Alfred, it's 2021. Yeah, well, it doesn't feel like it. Feels like a new year, same crazy. Again, welcome to the show. Got a lot of fun things to talk about today. Give you a little bit of a market update, right? But we got a fun financial planning topic starting the new year. A lot of questions coming through about credit scores. All right. And so we're going to give you the lowdown here on what we think about credit scores, do's and don'ts, right? How are they evaluated? We even got a guest for you guys today. We got Nikki James joining us. You've seen her in the past on some of our shows talking about mortgages, but she's also really good at helping people think through their credit scores, maybe how to improve it in the short run, if that's something that you're needing to be able to apply for a loan or apply for some credit, right? So we'll get to all of that in 1 second. But as always, for those of you guys joining us on this stream, if you're liking what we're talking about, hit subscribe for me, hit like, right? It helps us a little bit to know what the feedback looks like. So make sure that you guys hit subscribe so you get notifications on when we got something scheduled live for you. Again, every Friday at 3 p.m. Raymond and I are on here talking to you guys about some of these topics. All right. But before we get started, wanted to, of course, give our disclosures, right? I want to make sure that if you're watching this, we're not here to provide you personal financial advice. That's for something that we do one-on-one with our clients. If you're looking for that, right, make sure you go on to diversifiedcapital.com. But anything that we talk about here is more for education reasons only, and making sure that you guys are asking the right questions. All right. From an investment standpoint, right, we're never going to be here talking about soliciting you to buy anything. Again, education is key. Making sure you guys are learning about investing. Not that we're going to talk about that much, right? It's going to be more about credit scores and that topic today. And then finally, right, if we're talking about anything legal in respect, we are not attorneys, right? We're not acting to be your attorneys. And so there's something that comes up there. Make sure that you're referring back to your legal professional for that guidance. All right. Another week, second week, right? Again, like you said, we're headed into a 3-day weekend.
Yeah.
And you know what? We saw the market take a little bit of a slide this week, huh? I mean, just a splash. I'll put up the data in just a second, but give us a little bit of how the market did this past week, and what is your take?
Yeah, definitely. So the market, at least for S&P 500, just a quick update on the week, is down as of today at 1.5%. Dow Jones was down a little bit lower, but still at 0.9%. NASDAQ actually had the biggest losses this week at 1.54%, right? I think the week started off a little bit stronger, but just given all the turmoil that's been going on, we've seen it kind of slow down towards the end, especially with all the stimulus bills that's still in the talks that hasn't quite been done yet.
Yep.
So a lot of things that's still lingering on and getting worried for the market, right? So
yeah, and I feel like hanging in the balance is one way, right? We're what, another week or so until President Biden is inaugurated, right? There's lots of talk about what his new plan is going to be, an increase in those stimulus checks out to people. But I think there's still some debate between economists about how effective that extra money is going to be, how that extra $1,500-$1,600, right, is going to be an impact for the long run when we're talking about how well the U.S. is going to do. And partly, I mean, a lot of clients have asked me, well, okay, technology did really well in 2020, right? Stock market in general, S&P, right, did 15-16% for the year last year. Are those going to be continued trends? And we are starting to see a little bit of a shift. Okay, we're talking to our partner Nathan, which you guys have seen on the show before. He was saying, hey, in the last few months here, emerging markets, okay, overseas, right? You're seeing that outperform the U.S. Okay, could it be because of all the money printing that we're doing in the U.S.? People are worried about the value of the U.S. dollar going down, and sometimes that helps the emerging markets, right? Also, right, we're also thinking through some of these small companies if the vaccine rolls out, right, if we're going to get back to a little bit more normal life, the smaller companies could be seeing a recovery there. Okay. And so small size companies, about 30% increase over the past 3 months, right? And so we're seeing a little bit of a shift from smaller companies, maybe from the large companies that did so well in 2021. And finally, what I've been talking a lot about, and we've been talking on the show a lot, was the discrepancy between NASDAQ,
Mm-hmm.
S&P, and Dow Jones. They represent, remember, three different categories of the large company space in the US. NASDAQ being the growth companies, maybe the exciting names, that was up 42% last year, roughly. You had S&P 500, kind of the 500 biggest companies in the US, the blend, let's say, that was up
Mm-hmm.
about 15-16% last year. But then you had the Dow Jones, right? The industrials, the value companies, right? Maybe the bigger companies, the more stable companies. Those guys were in the single digit range last year, right? And we're actually seeing a little bit of a shift right now, right? A little bit of a shift where people might be getting a slight bit tired of how crazy the tech side has been and growth side has been. We're seeing a little bit shift back over into the value side. So those are some
Mm-hmm.
of the areas that if you're watching your own portfolio or thinking through maybe what areas you want to make some shifts to, watch out for those, right? That sometimes tech can't go on forever. Doesn't mean you should get out of all of it, but it's one
Mm-hmm.
of those things that we're seeing just a little bit of a minor shift right now headed into 2021, right? And so at the end of the day, right, I think we as investment professionals are looking at this and saying, well, there's still, again, a lot to be decided, especially once inauguration happens, once Biden takes office, right? How is that going to impact the jobs market, right? Is it going to be a case where jobs start to pick back up? Because, Raymond, I shared this with you in one of our team chats, right? In December,
Yeah.
140,000 jobs were lost in the US. Okay. And that wasn't a trend that people wanted to see. I think that was much worse than some of the expectations there.
Mm-hmm.
And I think what was more interesting, for those female and women listeners out there, it's not going to be a good thing for you guys to hear, but 140,000 jobs lost, all of them were held by women, right? Now, maybe the title's a little misleading at times, right? But this is an
Mm-hmm.
article, I think sometime last week, January 8th on CNN Business. Look it up. It's a real, and we'll link it into the bio as well. I just want to bring some light to the gender gap, right? And thinking through the idea that, I mean, you should know that there's this issue here where in the maybe because of COVID, right? The pressures of taking care of family right now still majority falls on women, and that is whether fair or not. I don't think it's fair, but hey, that's what's
Mm-hmm.
happening, and pushing them back into homeschooling, right? People that are needing to do distance learning, it's putting a lot of pressure on women in the workforce to stay at home, and we're seeing some of that. Now, a lot of the data also suggested that uh, the fields that are getting hit the hardest, right? You're seeing retail, you're seeing hospitality. Those were also areas that were also dominated by women holding those positions, and that led to some of it. Again, just something that we wanted to share as a shocking
Mm-hmm.
piece of
Yeah.
news article and data that came through, right? And so, and I think at one point earlier, right before the pandemic, in the U.S. economy and in the U.S. workforce, actually women held more jobs than men. Right. And that was like one of the few times in history that that had happened, when we had exceeded that point earlier, right before the pandemic. And of course, some of that is changing right now. So I thought that was interesting to share with you guys. Right.
Mm-hmm.
But we'll see. I think a lot of people are still looking for those vaccines to help the economy recover. And we certainly hope that is the case as well. Okay. All right. So we're going to be able to jump into credit scores right now, talk a little bit about what is a credit score. Should you be caring about your credit score, right? How is that going to impact you as you grow your finances, right? We're going to bring Nikki James on in just a little bit to talk about how she sees credit scores affect mortgages, what she's looking for, but more importantly, what someone can do to improve their credit scores in a short amount of time. But Raymond, tell me a little bit about what is a credit score? Like,
Yeah.
what is this idea of a credit score? What is it referencing?
Sure. So, I mean, the credit score is basically a three-digit number that evaluates in different factors that we'll talk about. Just your credit worthiness, right? Think of it as if you were lending somebody money, you would want to make sure that they have good creditness, right, to be able to pay you back. So, similarly, when you're in the act of, of taking a loan out or taking some type borrowing some money, they're going to check your credit score just to see from their side because they're taking on the liability and wanting to make sure that you can pay it back, right? So this risk score is generated from a few different credit bureaus. They all kind of have their own guidelines, but for the most parts, we'll talk about on a high level what they look at today and how that overall impacts your ability to get a loan or just other scenarios where that would come into play. So according to actually credit.com, the average credit score is going to be 703. So we'll talk a little bit more about kind of where the ranges are between the credit scores, but just wanted to provide some of that input out first.
Yeah, and
Another,
we'll ask Nikki what she thinks
yeah,
about a 703 credit score if you're applying for a mortgage, right? What does that impact look like? What is the difference between 703 versus 750 versus 650? I wonder what her take will be, right? We'll bring her on in a second. You
mhm.
had something to add there, Raymond, right before that.
Yeah. So I mean, outside of the credit score, I'm sure we also hear a lot about FICO scores, right?
That's true.
We just hear the word FICO so much that I mean, I didn't even know until recently what it actually stood for,
Yeah.
just because we use FICO so much, but it actually stands for Fair Isaac Corporation. But I like to just go by FICO anyway. So I just wanted to put that as part of educational points.
Yeah. So, and where is it used? Like, I mean, like you said,
Yeah.
is it always where you're anytime you're just wanting to review your credit? Like, where is it primarily used where that score would show up?
Yeah, I mean, there's a lot of different instances, but I think on the highest level, if it's going to impact or if you're going to be borrowing some type of money, then you can suggest that your credit score is going to be checked. Okay. But some common ones would be, for example, like opening a credit card, right? When you
Hmm.
open a credit card with Bank of America, Chase, Discover, or any of those type of credit companies, they're going to check your credit score, right? They want to make sure that you're able to pay it back. And it also goes into factoring how much that they want to lend to you as well. Okay. Other types of instances would be if you were taking out a personal loan, right? Or even borrowing money to purchase a car, like an auto loan, mortgages, refinances, where we'll have Nikki come in and talk about as well. Other instances too that doesn't quite fall into it would be, when you actually apply for a job. There's some jobs that want to check your credit score to make sure there's no past history, there's no bad debt on there, and even possibly renting an apartment too, right? When you go out there and rent an apartment or rent a house, they're going to ask for your credit score. It's just another way for a landlord to see, are you responsible enough and paying back credit when you're borrowing it. So
Yeah. Some of you guys know out there who watch this and know me. I'm a huge San Jose Sharks fan. Last week, I don't know if you guys heard, Evander
yeah.
Kane, right, a huge star on the Sharks, filed for bankruptcy and had $26 million worth of debt. That's not going to help his credit score for a little while, right? And again, tough to see a sports star like that with that type of debt. But again, it's fair for maybe an employer to look at that and be like, all right, hey, or even a renter or a landlord to be looking at those to make sure that you can have the ability or you're shown history to be able to pay that, which is a perfect segue, right,
Yeah.
into bringing on Nikki James and talking about what she's seeing in credit scores because, again, her role being a mortgage advisor, helping people get successful loans, is determining how well they can pay back this loan for the bank to take on some reasonable risks. All right. So we're going to add Nikki James here. Nikki, welcome. Happy Friday. Oh, Nikki, you are muted. Let me see if I can unmute you.
There you go.
There we go. Awesome. Hi,
Nikki.
Nikki.
Hi. Happy
Yeah.
Friday to you too. Yay.
Happy Friday.
Thanks for joining us.
Love to have you on. We always enjoy doing shows and webinars with you. And today, slightly different. We're not quite talking about home buying and mortgages, but we're talking about the credit scores themselves. And I know, and because I've have clients talk to you about this, about what their impact is of their credit scores, right? So a lot of people aren't aware of what their credit scores are even before they come to you when they approach a big credit decision, right? And so tell me a little bit about, as someone comes to you applying for a mortgage, what are you looking for in their credit? And if you don't see something that you like, how do you help them improve it?
Yeah, great questions. Yeah, credit is so fundamental. It's where we begin. I mean, this is sort of like there's no point in going past that. So we in the olden days, we didn't used to have this as a system. So we were just relying on income and rental history, perhaps, but down payments. And now, yeah, we're looking really to see what is your history? What have you recurrently done in the past that'll give us a good idea is, are you going to pay us on time? If you've only ever borrowed, $500, $1,000 before on a Macy's card, and now you're asking us for $500,000, yeah, that might be a problem. So really what the main thing that so it depends, and I'm going to get a bit jargony here, so reel me in if you need to, but loans nationally that are under 548,000, you just need a score. So, and you need a score probably above 680. There are some options under that for sure. These loans are called conforming. They're sold to Fannie and Freddie. Those are the quasi-governmental agencies. And so those loans are a little bit more flexible. Not so relevant in our area, in the Bay Area. So we tend to be in the non-conventional loan or what we call jumbo. And that's where we get into a lot more detail on credit's depth and credit score. So for a larger loan, anything above 548, in the Bay Area, we do have a stepped up number of 822. Told you I was going to get kind of detailed here. So because it's an expensive area, Fannie and Freddie will buy loans up to 822,000. So as long as you have a credit score in the Bay Area around 680 or above, you're probably okay if your loan amount's under 822. Once you go above that amount, though, we're not just looking at score, we're also looking at depth of credit. So a jumbo loan, we probably want your score to be above 700, above 720, great. And once you get into the 740, 780 land, you might get a better interest rate. So it might actually translate to cheaper cost of money for you because you've shown to us that you know how to manage credit. So that's the score piece. Depth is the next part. So when we're looking at depth, a lot of people don't know that we look at this, and not all loans do. But some do. And so if you want to have access to all the loans out there so you can look for the best rate for your profile, for you, whether you're moving up and you already have a house or if this is the first time, if you want to look at all, what we would like to see is at least 3 trade lines. That would be a credit card, car loan, student loan, 3 student loans, 3 car loans. Probably not a good idea. That's a whole different conversation. 1 car loan, 2 student loans. I know, I'm talking to the car guys. I forgot about that.
Yeah. Like 3 car loans. All right.
We do that every time.
Work with that.
Need one more.
Oh my goodness, yes. So what we're looking at is number of trade lines. So the number of things that report. So somebody was asking me the other day, well, what about my cell phone? Or what about, these are other things that we pay recurrently. They're not reporting to credit. Rent doesn't report to credit. So we don't call that a trade line. So we want 3 that are at least 2 years old and have been active in the last year. So just like what you said earlier on, like we were chatting and you canceled a card.
Credit card. Oh, so yeah, I was thinking if I was going to bring that up or not, but you're going to bring it up for me. No, I'm kidding. What Nikki's referring to is, right, talking about credit scores and how to do, and we're talking about do's and don'ts, right? One of the things is, right, maintaining those credit history of a credit line. So real story, I had a credit card from back in probably high school. I think my parents were trying to be responsible for me to build that credit early. Yeah. And I mistakenly didn't have anything on that credit card for a long time. And so by default, when that happens, the credit card closes because you don't put anything on there. They don't want you to have that outstanding line available. But that was some 14 years of history or something like that on that credit card. And so by having that drop off, it actually cut my credit history in half. Okay. And so because that was by far, that was like the only credit card that I had for a long time. And so when it cut my credit score in half, it dropped my scores in probably like, I don't know, something massive. It was like 50 some odd points. Right. And so, those are things that you have to watch out for. And again, even for someone like us, it's hard to keep track of. And we'll talk about that awareness, right? We talk about awareness and budget. Awareness and credit history is also going to matter. And how do we monitor that? So we'll get into giving you some steps on how to monitor it. But yeah, that's definitely a real story, guys, right? Like in terms of losing out on credit history and dropping your score, it could be big.
Poof, there it went.
Yep.
And so, yes, we're looking at, the depth of credit, which you just lost that. So if you do have an old card and you just put a tank of gas, I would just a tank of gas once a year, that's all it takes. Don't need to rent it up. We're not asking you to use. So a lot of people go, oh, great, I can go out and get into debt. No, we're not looking for you to be into debt. We're looking for you to manage it. Have you made a credit request and then paid it off? Have you made it and paid it off? And when we see you're currently knowing how to pay off multiple trade lines, we feel like, hey, they can probably handle a mortgage as well. So that's the thinking behind that depth of credit.
I think that's interesting though, right? Because, most people be like, well, I don't have any debt. I must have a good credit score.
But then there's nothing for us to look at, right? There's not enough data for us to say, are they a good risk or not?
And I think that's the whole point. And it's this odd idea that like I must be a good borrower because I don't take on debt. I was like, no. It's that all credit score is saying is how well you're able to pay off debt that you do take on, right? And it shouldn't be a lot because there's an idea that, again, depending on how much credit you have available to you, right? You shouldn't be using up all of that either because that's going to hurt your score, right? That's called credit utilization, another factor of credit scores themselves. Yep. But I think that's a common misunderstanding, right? That, I should have a decent credit. No, you just have no credit score, unfortunately, right? Like, it's not that you have a bad one, you just don't have one, right?
Because we run into that a lot with people from out of the country because they just historically, traditionally, culturally don't like debt, and they come over and they're like, oh yeah, that's an American thing. We don't want to get into debt. And no, actually you do. If you want to transact in the US, you kind of do.
So how do you deal with
debt? You just want to manage it.
How do you deal with that? How do you, if somebody, right, comes to you, right, and maybe two parts, right? So if someone comes to you and they're looking to apply for a mortgage and you want to help them increase their credit score a little bit, because maybe it's to get them above limits where they can actually get a loan, right? Or more so to get it up so that you can get slightly better rates. In the short run, is there something somebody could do to bump their credit score up?
Yeah, there's a few things there. And the first thing I would say is we come to see us as soon as possible, because once we know what we have, then we can lead you, and maybe it's just a quick fix. Sometimes it's a 2-year process. The worst thing is when somebody comes to me, I don't have the 2 years because they want to buy a house. So you end up paying a higher rate, essentially. We can often get you a loan, but you're going to pay more for it because we don't have that history. So the sooner you get to us, the sooner we look at it, the sooner we analyze it and help you, the better it is. Even if it's 2 years away, great. Let's at least set you up to buy a house in the future. In terms of, I think the number one thing that works fast is the utilization that you said. So if you have $10,000 worth of credit availability and you have one card with 10,000 and you have 9,000 on it, that's 90% obviously of your utilization. That's your score will be low. But if you had that 9,000 on 3 cards, 3, 3, and 3, that all had, let's say, a $6,000 credit limit, then you're at 50% utilization. Your score will be tremendously better for that. What is the best is to keep it under a third. If you're under a third of balance, because at any given time we all have a balance, and it doesn't mean to say, so a lot of people say, well, I run it up 100%, but then I pay it off every month. So I should be great, right? Well, no, because we might go on day 28 when you're about to pay it off on day 30, and it looks like you have $9,000 outstanding on your $10,000 card. So being strategic in when we pull can matter. So if you are in that situation and you're about to go and think about buying a house, make sure before your lender pulls the credit that you've told them, hey, hang on a second, I need to go pay that card off because I was going to pay it in 3 days before you run the report. It takes a little time to go through, but it is there is a way to rescore afterwards, but some lenders, some loans don't allow us to use a rescore. What a rescore is you show me your statement saying, okay, Nikki, now I paid it off. We rerun the credit. Most of our loans require it or allow it, but some of the direct banks, the bigger banks, don't like to see credit rescores. So just be careful there.
Got it.
So the third of the available credit is the big thing on each trade line.
Yeah, available credit. And that was exactly what I was going to talk about too, right? Is like, but this takes time. This one takes a little bit more time, right? If I understand it, is that, if you have and I think also it goes into like tying back into the clients or someone listening today, right? Sometimes they're afraid, I think, of having too much available debt, right? Like they're like, I don't want a credit card.
I'm tempted. Yeah,
I'm tempted. But if you're
rip up the card.
Hopefully we are, doing the right things around our finances, right? That, this is just to prepare you to have a better score. And doing
Mhm.
things like, for example, going to your existing credit card as your income has gotten better to request for your credit line limit to be bumped up, right, over time.
Mhm.
Right, that's something that is a common practice that most people don't look at. Like, I don't think some people would have like looked at a credit card they've had for 10 years and say, what's my credit limit there? If it's still 2K, right, if you bump that up, it allows your, again, available credit to start to increase. And as that available credit increases, again, this odd nature of your credit score will start to show that other people are willing to give you this much money, thus maybe I should be able to give you this much money, right? And so it's that idea around credit scores that once you wrap your head around it, I think you'll have a better understanding about how to improve your score, right? And so, hopefully what you're also hearing from Nikki is also planning ahead, okay? Because some of these things take time. Opening up a line of credit immediately and checking your score a month later is not going to help you, right? You haven't shown enough ways to pay it off. In fact, in the short run, sometimes these things can bump your score down, right? Potentially because of a credit check or a credit inquiry, which we'll talk about that at the end here as well. But Nikki, it was really nice to hear from you to talk about just what you're seeing in terms of not only the mortgage side, right, but how you've helped people in the past bump up their scores and having some tips there. But again, I really wanted to thank you for joining us on this today. I always enjoy having you on our shows, Nikki. It's so much fun.
Love to be here. Thank you for having me.
And we hope to have you on another show soon to share more of your expertise, okay?
Sounds great. Good luck to you. Thanks.
All right. Thank you so much, Nikki. All right. And again, Nikki from Flagstar Bank has again been such a wonderful partner of ours. If you guys are needing any guidance on mortgages, she is definitely someone to go to figure out where your best options are. Now, to close out the show, Raymond, we've talked about a lot about credit scores. We talked about ways to be using it. Summarize for us, what do you think are some of the do's and don'ts? Of course, don't, like me, close out a long credit history credit card. Share with me a little bit about some of the do's and don'ts with your credit score.
That's actually the first one that I wanted to tackle was what you did, Alfred.
But, cool, thank you.
Alfred and Nikki talked a little bit about it already, but with actually just take a step back, right? In terms of how a credit score is evaluated, there's a few different items. Okay, I'm gonna put it in the order of importance, or at least the largest impact on your credit score. Okay, the first one's going to be making payments on time, right? That's a really big thing there, making sure that you have the responsibility of making a payment when it's due. Okay, it doesn't mean to pay for all of it, but at least making a minimum payment is something that will satisfy the credit company, and you'll probably owe some interest on whatever's left over, but that's something that they won't report to the credit bureau as long as you pay a minimum balance there. Okay, the other one's going to be the credit used. So Alfred and Nikki already talked a lot about that, but this ties into closing credit cards. Actually, like when you close a credit card, you lose that credit balance, right? So that actually kicks into that utilization, where if you are putting more on your credit card now, that percentage is going to go up, right? Because your credit has gone down or your balance has gone down in that point. The other item is going to be just your credit history, right? That still, once again, ties into closing your credit card, but the history goes a long way. I think actually ranges, but it takes about 25 years of credit history before you're considered excellent on this specific category. So
cool. I just lost out on like 7 years of that, so I have to take some time to rebuild that.
It kind of goes back to the question too about how do I even get a credit card if I don't have any credit, right? It's kind of getting in that question where how do I get a job if they're asking me for experience? I don't have experience yet, right? So early on as kids or people are in college, sometimes it requires their parents to create a credit card for them, and they can still earn some credit that way. Now, it's not going into debt all the way, but spending a little bit here and there and making sure it gets paid off will definitely help you get started, right? For when you get out of college and start taking on a little bit more debt in that case.
Yeah.
The other last three here is not as high impact, but inquiries, as Alfred mentioned, right? There is going to be a hard inquiry as well as a soft inquiry. Now, what are the difference between the two? When you request for your balance credit to go up, generally credit card companies will do a hard inquiry on you. Some do soft, so it's good to definitely read the fine print there on what they do. But a hard inquiry actually allows them to get access to your credit score and reevaluate it again. Whereas a soft inquiry, they're not accessing your data, but they're looking at more of an overview from your past history to see if they want to increase that balance or not. So there are a difference between the two. Soft inquiry actually does not impact your credit score, whereas a hard inquiry does. Okay, so the number of inquiries or hard inquiries that you receive in a year will impact your credit score, where generally they want to keep it around 0 per year, but if you can do it within 1 or 2, that's something that shouldn't impact your credit score too bad, and something that will be regained fairly quickly as well. Okay. The other two would be just creating new accounts, right? The more accounts that you're creating, this might look bad on your end just because you're creating things, especially if you get denied. But on the other side, if you get accepted, that might look good, right? That means that other companies are accepting you and taking on your liability there.
Yeah.
And the last one is just the available credit, right? That kind of ties into the utilization as well, but trying to keep as much available credit as possible. Nikki mentioned 30% and under, or at least 1/3 of your available credit. That would still impact your credit score slightly, but if you can keep it within 10%, that shouldn't change your credit score at all. So that's something that you can kind of keep on top of. That should definitely help you there.
That's
So
awesome. And now, are there ways that, like, using apps out there, right, that should help you better monitor your credit in general, like the awareness that we talked about?
Yeah, so there are different tools out there like Credit Karma. There's Mint that helps you out with there. If you already have a credit card, I feel like a lot of companies are starting to have simulators for you to access, and it's pretty close to what the credit bureaus would be, because also derives from them as well. Like each of them use a different type of bureau, but those are tools that are accessible to you if you have a credit card. And for myself, I have Capital One, Bank of America, Chase. They all actually have credit card checks on a monthly basis that you can go in there and just see, and monitor how it's going each year. So
Yeah. I think one final thing that we're going to close out on is, while we've talked about all this credit, I think in the past, I don't know, 5-10 years, the likelihood that your identity has been stolen or is out there to affect your credit has been huge, right? And so the one thing that we talk about to our clients is credit freeze. Okay. It's not quite the same as credit monitoring, right? Where something has happened, you get a notice for it. But credit freeze or lock is something that you can place with the people who evaluate your credit. So Equifax, Experian, TransUnion, right? You go to these bureaus and actually place a credit freeze on your actual credit itself. And what that happens is, doesn't mean that you can't use existing lines of credit, but if you try to open, or someone has your identity and tries to open a new line of credit, it won't happen. It will get denied. Okay.
even you as well.
Right. Even yourself. Right. And so might prevent me from getting that new car unless I know the password. No, I'm just kidding. But, you want to go and try to look at your different credits. And actually, if you're thinking, hey, I'm not going to need to build or open new lines of credit in the near term, you might want to do yourself a favor and protect yourself and do a credit freeze. And it's actually quite easy, as long as you have your password saved and all of that, to be able to unfreeze it when you need it. Okay. Sometimes instantaneously. Okay. So there's really not much harm in going to make that credit freeze itself. And I think that gives you the best protection from someone who, again, at this point in time, I just assume somebody has my identity information out there somewhere. It's just a matter of whether or not they're going to use it. By having that credit freeze gives me a little bit of peace of mind that they can't just go open a line of credit and then me getting a notice about it later. Right. All right. So again, that closes out our show for today. I hope you guys enjoyed the way that we talked about credit. Hopefully you guys are learning a little bit more about how you can improve your credit score in 2021 and achieve the goals that you're looking to, whether it's buying a home, right, buying a car, just, again, having a healthy financial picture, right? Building those lines of credit up. Hopefully this is useful for you guys. A couple things, exciting things. Again, our annual financial planner is on sale on Amazon. Our team worked really hard on that. I know some of you have asked, like, how can we get access to more information from you guys without necessarily working with you one-on-one yet? I'm not ready for that yet. That's okay. We have something for you. Okay. Check us out on Amazon. We're going to link it below in our post, right? It helps you, guide you through weekly budgets, targets, different tasks to be working on throughout the year. And hopefully that you guys find some use out of it to be able to learn more about your own financial picture. Okay. Again, thank you so much for joining us again. We love having you here. Raymond and I always enjoy doing it, right? And we look forward to seeing you guys next week again, Friday at 3 p.m. Make sure to hit subscribe, drop us a like here so that you guys can get notifications as we go live next week. Okay. Awesome. Thank you so much. Happy Friday. Happy Friday, Raymond.
Yeah. Thank you, Alfred. Have a
See
great
ya.
long weekend.
Okay.
Yeah,
Have a good one.